thank you very much for having me this morning, and thought we'd share a little bit of our perspective. The first thing I always ask opening these is, do you remember where you were in March of 1980? Anyone? Yeah. There we go. Thanks, Nancy. I was standing at a phone booth in Boulder, Colorado, at an MAI course, and I was on the phone with the head of Northwestern Mutual real estate department and anxiously awaiting the approval from their investment committee on a joint venture equity recapitalization of a hospitality asset in Hawaii. And of course, he said, you obviously haven't seen the news, but Volcker's spiked the interest rates to close to 20%. And as I dropped my roll of dimes, it was a payphone, rotary payphone, by the way, and thought my 18-month career in the real estate investment banking business was now gone, we ended up ultimately recovering from all that. And I could take you through times of 1986, early 1990s, 94, 98, 2000, 2006, and then through our little fun times here during COVID. But what happens in the end is that we all do survive it. It's painful, depending on what sector you might be in, and it's painful depending on what kind of capitalization structure you've chosen, whether it's highly leveraged or conservatively leveraged. But in the end, we all end up with real estate, and again, not all sectors, up and to the right in terms of value. And the reason why is it's got cash flow, ultimately, and it ultimately has inflation mitigants, if you will, not necessarily protection in all sectors, but mitigants. And that, in the investable world, is a great combination, and why our sector ultimately doesn't only survive, but prospers. And what we do here is sort of look at how real estate will perform during this environment. We've got high replacement costs and limited supply. In fact, with certain exceptions in the multifamily sector, in certain submarkets, we have a fairly full complement of real estate assets that are fairly stable. We have stable rent and demand in the favored asset classes. We have a very, very, very solid job market, a slowing consumer, but still a consumer that has a lot of enthusiasm relative to what they're doing. We have a rallying public equity market, which has helped with what has impacted us in the past, the denominator effect, if you will. Stabilizing long-term rates, and again, I'll talk a little bit about how January, February, and March have kind of played out relative to how these rates have gone up and down. We've gotten through what we'll call the market pricing, 75 to 100 basis points of SOFR cuts now, and I'll show you a little bit around how the market has responded to what the Fed's dot plot looks like, and how their anticipation of something much faster than the Fed has speculated, or at least put out there, and how that has now come into alignment. We have tightening debt spreads. Obviously, it's a risk-on bond market. And it's likely, in our opinion, and through their statements, that the Q2 in potentially as early as QT in Q2 is likely to occur. So, but here we are. Some of the challenges that we see is obviously that SOFR's higher potentially for longer, and those rate cuts are likely to come this year, but they're likely not to come as dramatically as people would hope. And the 10-year looks like it could be longer, or higher for longer. And we put the ish in there because there's sentiment on both sides of whether or not that 4.25 should it be 3.75 on a stabilized basis or not, and what does that mean in terms of long-term borrowing rates, but what does that look like in terms of residual cap rates and the spread therewith over a 10-year treasury, which is what the impact of a 10-year forward looks like. And then challenging liquidity due to QT, and then bank pressure, not only the regulators with the major money center banks, But certainly with the challenges in the regional banks, there is going to be less capital available. Now, the good news is there's probably going to be a supply constraint. But it's also ultimately a challenge because they are the financiers of small business, which is the driver of our economy. And then we have Treasury issuance that is at record levels, $1.8 trillion in deficits at full employment. And then we have the election volatility and the risk associated therewith. We talk about potential recession risk, but that is seemingly looking closer to a soft landing. We do have some challenges, obviously, in what we'll call the more commodity older office. And as was mentioned, there is conversion potential, but not all commodity office has that conversion potential. There's a structural change out there in terms of back to work, back to office, if you will. And then we've got this regulatory issue. And then slowing China, which has an impact potentially, and I'll show you a chart that shows you where our budget deficits are and who's been buying in China and Japan, who were our two largest buyers of the debt, ultimately has slowed down. So when will the market stabilize? When will FOMAM, which I call the fear of making a mistake, as opposed to FOMO, which is the fear of missing out, when will that begin to shift? It feels like it's beginning to, in some ways, stir at least some of the animal spirits. And when Muhammad came down from the mountain at 345 Park and declared that the real estate markets were bottoming in terms of valuation, it has stirred people. And then ultimately we had rates dropping in January, which had people enthusiastic about the direction of it, but it also had them hold off in many respects in terms of transactions because they thought if rates continued to come down, maybe they could get a little closer to their pricing. And then February hit, rates went up, that oh shit moment. And what we're seeing at least is a large pipeline of people who are ready to transact finally on the seller side. We've had some buyer capitulation in certain sectors, particularly in the multifamily sector and the industrial sector. And that's good news at the same time. But I think this will come together and that we'll see these volumes ultimately increase. And then here we are. What was the big shock again? Repeating the obvious, but it was really not so much the rates themselves, but the speed at which these rates occurred. And it was the 525 basis points in 16 months that just shocked the system. And then we had, at the same time, the balance sheet. You know, $90 billion a month was rolling off in terms of quantitative tightening. And we'll talk a little bit about some of the news that's come out more, at least in the last 30 days, relative to what the Treasury is suggesting could be a softer roll-off of that, which will help liquidity for sure. And that Fed action led to this massive, massive drop in the value of fixed income. It's recovering somewhat, but ultimately not to the levels that we were at. But it did shock the system, and it shocked the valuation of a lot of these regional banks who had, in essence, put 10-year treasuries on their books as a way to, in essence, get yield. And when that was revalued, their balance sheets were troubled. And then 22 was brutal. There's no question about it. 23 was surprisingly good for everything except for commercial real estate. So when you look at the GFC, just to sort of give you a perspective, in 2008, we had these significant downdrafts in valuation across the board. And in 2009, we had a recovery. And in 2010, we had a significant recovery, including commercial real estate volume. Different from that, with the current cycle, we've had equally good recovery in S&P 500, a little bit less so in REITs, which we'll talk about. And on the investment grade side, in terms of corporate bonds, there's been that recovery that I spoke of, but not so significantly. And then the question is, we continue to have a downdraft in terms of volumes in 23. 24, again, I've given you a little bit of an indication as to what the at least first 2 months of the market or the year portends, but it feels like we're going to have a significant recovery, at least through the second half. And then generally, the equity market's been resilient. Even with a 500 basis point move, you can see the S&P up 31%, and we peaked even in the REIT market at a 15% recovery in the last part of the year and the first part of this year. Equity volatility below post-GFC levels, with the VIX at 14 versus an average of 20. A little shocking because it feels like it's been much more volatile than that. But the bond market has been far more volatile than the equity markets, and we're still hovering in that 112 stage. And you see these spikes with SVB, COVID peaks, and the like, but we're still above at least the 5-year average. Forward curves, in terms of SOFR, rates have peaked. How fast will they fall? Again, we're looking at the gold line, if you will, is October of 23 in terms of what the anticipation was. 5-year at 447 versus 388. And the good news is we think we're going to get some QT relief in the near term. And that is they feel like they're going to level out. Again, if you see the latest notes, they'll level out the rate at which they're going to decrease that balance sheet. And then here's the Fed funds. This was the market at 4 cuts versus the Fed at 3 cuts. But if you look back and sort of what has created this pause, if you will, is the fact that the market projected that it was going to be a 442, and ultimately it was at 533. So what we do see is the market is coming in line, at least with what the Fed has suggested, and that means that there's a lot less guessing at this point in time in terms of the direction and rate at which it's going to fall, and the absolute levels. Elephant in the room, $3 trillion a year of deficit spending and QT, and we've got that in the face of China slowing growth and geopolitical issues, Japan raising rates to slow the yen slide. The Middle East has lots of money, but they're not buying U.S. treasuries. And this gives you a sense that here we are, it's now close to $34 trillion, but we've more than doubled in the last 10 years the deficit, and they have not soaked up, other than the foreign central banks, much of that at all. In fact, it's been decreasing as it relates to China and Japan. And then inflation in context, again, it feels pretty stable in terms of the 2-year and the 10-year in terms of the break-even points. And then the forward curve, which I mentioned earlier, which looks at where we are today versus where the 10-year is expected to be in 10 years. And as we look forward, not the guesstimate, but the market is suggesting 525 in terms of a 10-year, which then when you throw whatever spread you think should be in there for a residual value calculation, it's going to be in the 6s. And until that comes down, it's going to impact institutional, at least, valuations. The consumer is driving the economy. Sentiment's improved, still below average, but it's improving and improving fairly fast. And having said that, they're spending less, but still more than average. But they're borrowing a lot more. So you see here that, in essence, it's more than doubled since 20 in terms of debt, not just the cash they got in their bank accounts from the federal government, federal or state governments. And then here we are, an amazingly strong employment cycle. Again, while we look at real employment versus headline employment, clearly there is some strength around that 4% range in terms of what the Fed has been trying to solve for. And then this is just directionally where we see the value of construction being put in place. The purple is industrial, the green is multifamily, blue is office, and the retail and hospitality are in that sort of purple-ash and red, if you will. But it's peaked in terms of what's being brought to market, and that's going to continue, we believe. And if you talk to folks who are looking at re-entering, in fact, the office markets, the suggestion is that there will be very little new construction in the next 5 to 10 years, except for purpose-built construction. And that will, on a select basis, in select markets, in select locations, that will be a buy-in opportunity because the expectation is that rents will go up at a substantial pace. So in terms of the debt markets specifically, obviously a significant downdraft relative to 22, and then again in 23 down 47%, and it's relatively across the board. And then this is where we see the current state of the debt markets. Fannie and Freddie, the agencies, are open for business, but they're at market levels. CMBS is wide open relative to where the market is. Life companies ultimately are wide open, but have allocation issues. Debt funds and mortgage REITs, which are highly impacted by their back leverage, if you will, are open for business. And I think what you're going to also see is this new credit instrument that, not instrument per se, but this new credit sleeve that every one of the major private equity groups are anxiously pursuing, which is insurance company capital and annuity capital and pension capital directly on a core plus basis. And that's going to be fairly significant. If you read 345 Parks or Steve Schwarzman's view on this, they've got $195 billion of AUM in that space with clear line of sight at 250 for that and an ambition of $1 trillion. And if you go through Apollo or KKR or Brookfield, Sixth Street, all of them have an insurance company sleeve that they're going to be growing significantly. So watch that. That's going to be the answer to a lot of what will happen. Again, it's likely to be higher than life companies. But it will have some duration elements to it that I think will relieve some of the capital requirements that are going to be out there. And then foreign banks, sort of, again, relationship and rolling. Large U.S. banks only doing transactions that ultimately are relationship-oriented, and the regional banks much the same, and probably should be more of an orange than a red and yellow. And then high-grade bonds, there is risk on, even with a 75 to 100 basis point drop in rates, which, again, when we see rates drop, usually spreads go up, but we didn't see that. In the last round, we saw rates come down and spreads stay down. It was a little bit like ecstasy and white lightning at the time. People were borrowing short and floating rate, and they were ultimately counting on double-digit growth rates in terms of rental, whether it was multifamily or the industrial space, the logistics space. And then P&G, recent 10-year issue, T 37 basis points, the smallest risk premium on record. And then even the more risky high-yield corporate bonds, which we follow, are below the 5-year average and significantly headed downward. And then spreads on the AAA 10-year CMBS continue to tighten, stabilizing kind of in that 90 basis point range. And that's been pretty significant, down 50%. So we're seeing a lot of CMBS capital. And finally, we're beginning to see sub 6% financing rates, both on 10-year fixed, 5-year floating, significantly down from where we were literally in October. And having said that, cap rate costs have dramatically declined as well. And these cap costs, both the 2-year and 3-year, have been pretty expensive because, again, there was so much of this financing that was done in 2021 that were 2 to 3-year cap requirements. And as you can see, 20 times on the 2-year and 10 times the increase, which has caused for a lot of closed-end funds in particular to have to find alternative capital in order to fund these cap costs that are required. And then if you look at the CMBS market, we are now inside of 6% on a 5-year coupon, and this is across industrial, multifamily, life science, and then even some retail, which is, again, in the closer to 7% range, and hospitality at just under 9%. So the REIT bond market, which has fueled a lot of transactions, and you'll see some significant transactions in the next 30 days around all this. We've tried to take advantage of their financing costs and their ability to finance overnight to, in essence, get some large-scale transactions curated and done relative to these, particularly in the industrial and residential space. But as you can see, other than Office Kilroy having issued $400 million at 6.7%, these are well below 6% at the end of the day, and the issuance spread as low as 92 for Prologis. Delinquency rates, however, are continuing to be at least an issue for people looking at where we are in the cycle, and it's increased primarily in office. It's up 242% from 5.2 in January of 23 to close to $18 billion in January of 24. When we look at the BOVs that we've been involved in on behalf of lenders, whether they be banks, debt funds, or other, again, just under $44 billion of this that we've done. 80% of it's been office, multifamily, other, and hotel have been relatively benign. But the top 5 markets are San Francisco Bay Area, New York, DC, Los Angeles, and Chicago. Regrettably, only about 30% of this has ultimately transacted relative to what the values have been. And the banks themselves have decided they're going to, it's not blend and extend, but modify, if you will, what they're prepared to do unless it's something not worth saving at all. But that'll give you a little sense as to what the tenor and tone is of the banks themselves. And then, as it relates to how we're looking at the transaction volume, down from 22, 55%, 46% from 2019. The reason we throw that out there is that 2019 and 2020 were a little bit more what we call normalized and accentuated in 21 and 22 as a holdover. And so 23 is down. I expect that we're going to be in or around this range, slightly up potentially in 24. There is a lot of capital available out there. The problem in the real estate sector is that that capital that's available is available at 13 to 20%, whether it's value added or opportunistic. Very little core and core plus that's available. And so you've got this opportunistic and value add, but those have that cost of capital that is not exactly what everybody's looking for unless you're in the business of raising dry powder and closed-end funds. We do see that there's far more core and core plus ultimately in infrastructure vehicles. In fact, it's almost inverse if you look at it on a global basis. Of the $388 billion in real estate, the core plus, if you will, is only about a third of what the total is. But if you look at the infrastructure space, it's about 65% of the total is in the core plus. That's the good news. The bad news is the data center business and the capital required to fund, in essence, the demand for that is significant. And that's where infrastructure will likely stay as opposed to moving over. Now we'll see some things being done in the on-campus student accommodations. You will see some of that move into things like cold storage, if you will, some into logistics, but very little otherwise going forward outside of those 3 or 4 things, and I think significantly data centers. So this, while we were hoping that this was going to be something that we could tap into, and we have tapped into it, the bottom line is that it's likely to go into a sector. And it's the one thing I would just give everyone a word of caution around. Follow what this capital requires and what the capital is yielding. So a data center for a hyperscaler with credit, Microsoft, AWS, Meta, Alpha, Oracle, is about a 9% yield on cost relative to all of that. there isn't a lot of real estate that ultimately shows those kinds of returns. And so just watch that carefully, because the amount of money that's being projected to be spent in the next 3 years, $1.7 trillion. These hyperscale transactions can be between $1.5 billion and $2 billion with credit. It's going to suck up a lot of capital in the world. We're working on some interesting structures that ultimately will sop that up, but if we can't solve for that, it's going to put a lot of pressure on the commercial real estate finance market. And then the open-ended fund flows have slowed and reduced core capital. The REIT markets, the traded REIT market has exceeded 22, obviously still half of what we saw in 21, and that was mostly in unsecured and common. And then at least the non-traded REIT space has stabilized. And I think, again, BREIT has noted that they are at neutral relative to redemptions and the raising of capital. That's good news, because it reflects, what that space looks like. If we can get some turnaround in that as rates come down, because that's probably what's going to trigger it, we'll at least see some stability. But it's not a good headline when the largest real estate investor in the world is on the front page with a question about whether it's real estate, whether it's the structure, or whether it's the largest real estate investor having missed it. So this stability portends well in terms of things in the future. And then offshore capital demand, we're seeing foreign investors that got out when the Fed was tightening that are back in. That's good news. And there's a tremendous amount of capital, over $1 trillion more in the Middle East. And these are just the sovereign wealth funds. I would suggest that the capital that's being assembled and arranged relative to family offices that are, in essence, derivative beneficiaries of all of this is very, very significant, and the place to hunt. These folks are primarily doing deals that are platform, large scale, and that offer something strategically that go beyond just the investment itself in terms of operations, their ability to be able to get into these things and maybe even bring that expertise to their home countries. Current pricing. This is a chart that just looks at implied cap rates from December of 22 through October 23. The green is where we saw the peak 10-year Treasury right at 5%. So you'll see that in industrial, just as an example, that green dot was that industrial, which included the largest REIT, PLD, was implying roughly a 5.1 cap rate. Today, it's trading at 4.4, which is the blue, and the red was 12.1 of 22. Down below, this 3.4% is what the low private cap rate was during that 4-year period of time. And if you go across the board, life science got hit very, very hard, almost doubled relative to what the low cap rate was. And then if you look out on office, it was almost doubled as well. So we're seeing, at least in terms of the public markets, implied cap rates that obviously are coming in, but nowhere near where they were in the private markets prior to that. And then these are kind of public market indications, if you will. What does it tell us, between the public and private markets? And we're constantly trying to divine where that difference is. But we're seeing the S&P obviously recovering, and through December of 23, REITs through the RMS recovering, and then end of year total return to today, almost 12% on the RMS REIT index. And then this is Green Street's REIT sector index, which shows malls having recovered in the neighborhood of 36% from October, and office recovering 25%, multifamily 10%, but coming off of obviously values and valuations that were impaired a lot more than on the office side and the apartment side. And then on the private market pricing, It's off materially. Again, this is Green Street private markets indication, and one could argue that, again, not all office is at the 38% discount. It can be significantly more for the wrong office, but roughly speaking and directionally, these are the things that we're trying to then divine whether or not it's time or not, and this is what goes into our BOVs relative to given the lack of transaction volume and comps that could justify it. These are the kinds of things that we use to think about it. So trends to watch in 24, data centers, advanced manufacturing from our perspective. In terms of onshoring and nearshoring, construction costs aren't coming down much and industrial demand will increase. We think that the infill aspect of it's going to be much more of a play. iOS, low capex and outsized rental growth. Medical office is becoming part of a core portfolio. This does, by the way, play into the infrastructure space. And office is not dead. Bidding pools are starting to deepen. Good assets and good locations firming. Institutions are emerging. We did a transaction in Southern California. It was roughly $700 million at a 6% cap rate. It had a Google lease that ultimately Google never moved in. We actually sold it to a user who was UCLA and their quantum science department, and this will be not only for UCLA but for the whole UC system, the state, and ultimately nationally a leader in the space. And so we're seeing the right valuations turn out for that. This is the $1 trillion opportunity, which we talked about. And when you look at what's happened, 2x supply in the past 2 years and roughly half the occupancy or vacancy rate associated with that. The $1.2 trillion in terms of capital spend, the pink being AI, you're going to talk about that this afternoon or at least later in the day. And the blue is cloud to date. So the cloud really started in 14, kind of moved up. It continues to grow, but the next step is what AI is going to do in terms of all that. And then this is just some other aspects of the data center space. I won't spend too much time on that. But advanced manufacturing, again, we're seeing biopharmaceuticals, energy technology, food, textiles alternatives. This is going to be, we think, a big element. The onshoring in terms of driving increased industrial and iOS activity, nearshoring with Mexico, federal incentives in terms of supply chain, especially in the EV space and the Jobs Act. And then medical office, again, I won't go through this because I see that we're running out of time. And this just gives you a sense as to where we think the direction of travel is in the medical outpatient buildings. And then office is not dead. Will the need for productivity ultimately drive demand? Remote workers are losing out on promotions. And the fact of the matter is the marginal cost of a square foot doesn't drive it or bring more customers to the business, according to David. And what does drive it is productivity, and being in person, in place, is a difference maker. And then there is this bifurcation, however, relative to Tier 1, Tier 2, and Tier 3 assets, and within markets, the Sun Belt and the Gateway in particular. And then the bifurcation between asset tiers continues to widen, but only 3% of the buildings in Dallas, for example, contribute to more than 28% of the vacancy. New York City, 3% contributes 25% of the vacancy on a much bigger inventory. And then the divergence between the top quartile pricing and US office prices in general is 70% differential versus an average of 30% historically. So again, office isn't dead. The right office is back and coming back even faster. And then we see the office investment accelerating just in terms of what the office trades have been. I'm going to just go to final observations here. What's changed recently, rates have expanded, and with that cap rates have moved up. It's just the math at the end of the day. We do believe that with rates coming down, cap rates will follow, not necessarily in lockstep, and not necessarily across the sector, but where we see more opportunity for rental rate growth in certain sectors, that will be where we'll see that cap rate decline more intensely. And then the market has been up-to-date pricing rate cuts more than the Fed has projected. The continuing recession risk is out there, but most people believe that it's going to be a soft landing. And again, you'll talk more about that today, I'm sure, but there is an increasing confidence in the Fed. Equity markets have been very strong. Watch this second half of the year relative to election volatility and what that all means and what it could mean in terms of rate movement. People suggest the Fed is not politically driven. People suggest that it's wholly politically driven. But increased geopolitical instability is always something that hurts from a volatility perspective. But we do have capital accumulating as a result of stock market rally, energy prices. The economy and jobs are quite strong. The bond market is risk on, so tightening debt spreads. Rates have peaked. QT is likely to slow. And that the rally in asset prices hasn't yet affected the private commercial real estate markets, which is good news because the denominator effect has given us some room in all of that in terms of allocations. And then those who sat out, the 23, if you will, lost out on a 26% market rally. And so that's where we think that FOMO will ultimately kick in as opposed to the FOMAM. And then new supply completely choked off, or at least essentially choked off as a result of rates and regional banks. And then we do think this global capital market will come in. We think core capital is still limited, but when it comes back, it will come back, we think, through these credit markets. And ultimately, we think there will be non-traded REIT activity coming in the near term. And then there's this J-curve impact, which is these folks who have raised these large sums of money for closed-end funds have been sitting on it, and they have to get it invested. So you have seen a couple transactions that have occurred. I think you'll see in the next couple of weeks several more of these of scale. And the animal spirits, if you will, we believe are stirring in from, again, January, excitement, hesitation. February, whoops, missed it. March, where are we going in terms of rates? And I think that you're going to find then from the rest of the year on that people will ultimately meet the market. So with that, thank you very much. Appreciate your time today.